Section 5.1 Understanding Standard Deviation, Practical Applications of Standard Deviation. 5.1 Investment Decision Making. Standard deviation is a commonly used measure to assess the risk-return trade-off of investment opportunities. It helps investors evaluate the volatility or variability of investment returns and understand the potential risks associated with an investment in relation to its potential returns. When assessing the risk-return trade-off using standard deviation, consider the following points. Risk assessment. Standard deviation quantifies the dispersion of investment returns around their mean or average. A higher standard deviation indicates a wider range of potential outcomes and higher volatility, implying a higher level of risk. Conversely, a lower standard deviation suggests lower volatility and a lower level of risk. Return assessment. While standard deviation primarily focuses on risk, it also provides insights into the potential returns. Higher volatility, indicated by a higher standard deviation, generally implies the possibility of higher returns as compensation for the increased risk. Lower volatility, indicated by a lower standard deviation, typically suggests more stable and potentially lower returns. Risk-return trade-off. The risk-return trade-off refers to the relationship between the level of risk undertaken and the potential returns expected from an investment. Standard deviation helps investors evaluate this trade-off. Generally, investments with higher potential returns tend to come with higher volatility or risk, resulting in a higher standard deviation. Investments with lower potential returns usually exhibit lower volatility or risk, leading to a lower standard deviation. Diversification. Standard deviation also plays a role in understanding the benefits of diversification. Diversifying investments across different asset classes or sectors can help reduce the overall portfolio standard deviation. By combining investments with low or negatively correlated returns, the portfolio's risk can be lowered without sacrificing potential returns. Comparing investment opportunities. When comparing investment opportunities, the standard deviation can be used to evaluate the relative level of risk associated with each option. A lower standard deviation suggests a more stable investment with lower potential risk, while a higher standard deviation indicates a riskier investment with greater potential volatility. It's important to note that while standard deviation provides a valuable measure of risk, it has certain limitations. It assumes a normal distribution of returns and does not capture the full range of potential risks, such as tail risks or extreme events. Therefore, it's advisable to use standard deviation in conjunction with other risk measures and perform a comprehensive analysis when assessing the risk-return trade-off of investment opportunities. In summary, standard deviation assists investors in evaluating the risk-return trade-off by quantifying the volatility of investment returns. It provides a measure of the potential risks associated with an investment and helps compare investment opportunities based on their level of risk. By considering standard deviation, investors can make more informed decisions and align their risk tolerance with the potential returns they seek. Incorporating standard deviation into investment decision-making processes can provide valuable insights and help investors make informed choices. Here are some ways to integrate standard deviation into investment decision-making. Risk assessment. Standard deviation helps assess the level of risk associated with an investment. By calculating the standard deviation of historical returns, investors can evaluate the volatility or variability of the investment's performance. Higher standard deviation indicates higher risk, while lower standard deviation suggests lower risk. Incorporate standard deviation as part of your risk assessment to understand the potential downside and manage risk effectively. Risk-return trade-off. Consider the risk-return trade-off when making investment decisions. Higher potential returns often come with higher volatility or risk, as indicated by a higher standard deviation. Assess the expected returns alongside the standard deviation to determine whether the potential rewards are commensurate with the level of risk. Evaluate investments with different risk levels to find a balance that aligns with your risk tolerance and investment objectives. Portfolio diversification. Standard deviation is useful for portfolio diversification. By combining investments with different risk profiles and low or negatively correlated returns, the overall portfolio standard deviation can be reduced. Diversification can help mitigate risk and smooth out the overall portfolio performance. Analyze the standard deviation of individual assets or asset classes to ensure that your portfolio is appropriately diversified and optimized for risk management. Performance comparison. Use standard deviation to compare the risk profiles of different investments or investment strategies. Calculate and compare the standard deviation of returns to understand which options have exhibited greater volatility historically. This comparison can provide insights into the relative riskiness of investment choices and aid in decision-making. However, be cautious when comparing investments across different asset classes or time periods, as their risk characteristics may vary. Sensitivity analysis. Conduct sensitivity analysis by considering different scenarios and assessing the impact on standard deviation. This analysis helps identify how changes in underlying factors, such as interest rates, market conditions, or economic variables, affect the investment's risk. By incorporating standard deviation into sensitivity analysis, investors can evaluate the potential impact of various risk factors and make more robust investment decisions. Risk management. Standard deviation plays a crucial role in risk management. Establish risk management strategies based on the standard deviation of investments or portfolios. Set appropriate risk limits or thresholds and actively monitor the standard deviation to ensure that the risk levels remain within acceptable parameters. Adjust portfolio allocations or risk mitigation strategies based on changes in the standard deviation to align with your risk management goals. It's important to note that standard deviation is just one tool in the investment decision-making process. It should be used in conjunction with other factors, such as fundamental analysis, qualitative factors, and consideration of investment objectives and time horizons. Additionally, standard deviation assumes a normal distribution of returns, which may not hold true for all investments. Therefore, it's advisable to consider other risk measures and conduct a comprehensive analysis when making investment decisions.